Okay, everyone, this is Rob Barnett. We're going to go ahead and get started. I want to thank you for your time today. You have joined us for the BI Energy Exchange, where we talk about our research and the latest developments in the market. And given the roller coaster we've seen in oil prices, I think it's appropriate to start there. So we'll start with Salih Yilmaz. Salih, we had an OPEC meeting. We've seen prices retreat and then come back a little bit here in the last few days. Tell us what happened and give us your sense of what the fundamentals look like right now as well.
Sure, thanks, Rob. So we actually got a almost last-minute meeting on Sunday for OPEC, and we actually got a deal out of that meeting, which was our base case scenario when we thought OPEC Plus is here to stay, and their kind of strict supply management is necessary and in everyone's interest. So, as expected, they did come up with a compromise deal, and they will start bringing back more barrels into the market, adding about 400,000 barrels per day each month for the rest of the year. So I think this is a positive development for the oil market. I think this brings stability. Like now we know the OPEC Plus is still in unity, and they will continue to have this kind of tight grip on the market while demand is still far off from the pre-pandemic levels. However, as you mentioned, on Monday we did get a sell-off, almost 6% sell-off in both Brent and WTI. And I think initially most of the headlines that we saw were about the OPEC meeting, but I don't think it really had a lot to do with the OPEC meeting. Like I said, beyond the very near term, beyond the additional output in August, I think this is positive for the markets, but I think this was a general broader market sell-off. And I think it had a lot to do with concerns around the Delta variant. I mean, this has been something that we talked about within the UK, but I think the market is reckoning with the fact that this will soon be pretty much everywhere. And generally, we tend to focus on the US, Europe, where vaccinations have been good, but in some parts of the rest of the world, vaccinations have not been as rapid, and they are trailing Europe and the US. And the Delta might be a problem for mobility there if restrictions come back, and that obviously doesn't bode so well for the recovery in oil demand in the rest of the year, because all the calculations that OPEC has been doing, IEA has been doing, we have been doing, kind of assume just demand recovering for the rest of the year. And I think Delta we're seeing is a significant bearish risk for the market. And going to the second part of your question about kind of the fundamentals and the balance in the market, our base case scenario suggests that the market may remain in a little bit of a deficit for the rest of the year, which is, I think, where OPEC wants the market to be, to continue to deplete some inventories and kind of have that support level for oil prices, which we believe will probably stay range bound with a lot of bearish and potential bullish catalysts. We expect them to remain range bound between probably $70 to $80 a barrel.
Solly, I think that most of the consensus views out there, if you take IEA, for example, or OPEC, really see demand essentially back at pre-pandemic levels in 2H of this year. Do you think that is a reality that's likely to unfold? You obviously mentioned the Delta variant. I think everyone's aware of that at this point, but how far away are we still from that pre-pandemic demand level? And if we're not going to get there in 2H, when or will we even get back to that if you look out over the next couple of years?
This is a good question. Currently, I think we're still about 4 million barrels a day, if not more, off the pre-pandemic level. And I think all the agencies that you mentioned do see demand going back, not quite to the pre-pandemic level, but pretty close. I mean, like 1%, only 1% below the pre-pandemic level by the end of this year. We remain a lot more cautious. Our numbers suggest that we may still be more than 2% below the pre-pandemic level. We're still quite cautious about the return of jet fuel demand. We understand that, oil demand is coming back, not in the places that we always look at. I mean, we do see the top of the barrel, the naphtha, and the petrochemicals, the plastics coming back stronger, perhaps, than especially jet fuel. But I mean, we remain especially cautious about return of jet fuel. We are watching the return of business travel pretty closely. I mean, we think that may not come back ever to how it was before. So it's probably, I don't think any of the agencies, including us, have demand back at its previous pre-pandemic level at the end of this year, but almost all of them have, I mean, this differs between agencies, but most of them have demand back at pre-pandemic level at the end of next year. And I think seasonally, all these agencies are kind of assuming a little bit of a slowdown when we come to 4Q this year, and then for the first half of next year as well, they do see a little bit of a slowdown. But we really do believe that some of these battles that we lost in the during the pandemic, I mean, these are structural changes. We are seeing further acceleration of EV adoption. We are seeing impact that will kind of emerge from more teleworking that people will continue to do. So again, it's a very difficult question. I mean, it's a question that we ask in our surveys as well. When is demand coming back to where it was? But most agencies think end of next year. We are a lot more cautious about this.
Thank you, Salih. I think that everyone on this call right now is sort of wrestling with the transient effect, and then they've also got to try to sort out the structural effects from all of these big announcements related to policy. And for that, I want to shift gears and think a little bit about the gas side of the equation, particularly LNG. There was some interesting news out of Japan, one of the world's major LNG exporters, and they, at least for now, the government has revised its vision, and they're talking about vastly reducing the reliance on LNG if you look out to 2030. Now, the reality is, will it actually come to fruition? All these sorts of questions. But I want to turn to both Will and Elchin to get their views on this. We'll start with Will. How do you read the news out of Japan on LNG, and how do you think that the oil majors are interpreting it, given their exposure to the LNG side of the business?
Yeah, thanks, Rob. I think this news out of Japan, where the energy regulator has put forth their draft for their supply mix moving forward out a decade, and they have LNG roughly halving as a share of their supply mix for power generation. And this is quite surprising, and I think this will send a shiver down the spines of many of the energy majors for two main reasons. Number one is that Japan is the largest LNG importer in the world. They imported 77 million tons last year. And second is that LNG, natural gas, or particularly LNG, for many of the global energy majors, has been a cornerstone of long-term strategic positioning, and particularly around the energy transition, saying that which is sort of built on the foundation that gas will have a much longer demand growth profile for multiple reasons. It's better for particle in particles in air pollution. It's less carbon intense burning than other substitutes, and so seeing that LNG as a share of the supply mix in Japan is proposed to drop a significant amount. I think this is very scary for some of the energy majors, and may suggest that they have discounted the pace at which not only is renewables can displace natural gas and LNG in power generation, but I think also the cost of which renewables has come down so quickly.
Okay, Elchin, I want to come to you now. So you just heard Will sort of talk about it from the perspective of the integrated oil majors. When you look at the gas market and kind of think about fundamentals, I don't want to put words in your mouth. I think you've often been saying LNG's got a great near-term story, but you start to look further out, the picture for gas gets a lot murkier. What do you make of the news out of Japan, and how do you contrast against what you're seeing, particularly here in Europe?
I'm, as you know, as you just alluded to, I'm quite, cautious about the midterm outlook for gas demand. I do think there's more downside risk than upside, in my view. However, I think Japan is a special case because they're an island, just like the UK. They will continue to rely on LNG, and I do think their target of, I think, 20% of energy mix coming from LNG is too pessimistic, to be honest. I think it will be very, very hard for Japan to win themselves off from LNG or reduce its share to the degree that the country is planning to. And the key reason is that, I think the country is still overambitious in terms of how much they can bring back the nuclear. They've shut it following Fukushima, and that's really hard to come back. Like, it's been how many years since Fukushima, and nuclear is still a shadow of what it used to. So I don't think the ramp up in nuclear output that the Japan is expecting is going to be there. Plus, we're going to see a major reduction in the use of coal, which I think is going to happen. So the nuclear is not coming back online as much. Coal is coming offline. So yes, you're going to increase the amount of renewables you're using, but you do still need a lot of gas to balance that out. I don't see Japan building a lot of cables with power cables with China, Korea, or any other of its neighbors. It's much more remote compared to the UK. So I think LNG is going to be, maybe it will come down a little bit, but nowhere near as much as the government's current strategy paints it. So yeah, that's my view.
Love the contrast and the skepticism there, Elchin. One topic that I think aligns with this is some of the ESG pressure and divestment movement that's been unfolding. And so, Will, you put out a note this last week looking at Norway's sovereign wealth fund and the progress that some might describe it as progress, but the progress that they've made at shifting some of their investment portfolio and lowering their oil exposure. So tell us what you've seen out of the country and where you think they could be headed next. And frankly, what kinds of investments exclusions are they looking to make at this point?
Yeah, thanks, Rob. So Norwegian's sovereign wealth fund, which is also called or so-called the oil fund, it's about $1.3 trillion, and so it's a pretty significant player in global investment. Roughly 2 years ago, the Norwegian Parliament voted for the fund to divest its E&P upstream holdings. And we have just started to see the results of this vote. They originally said it would gradually occur, but based on our analysis of their most recent holdings, the fund has eliminated virtually all of their independent E&P holdings down to zero or very close to zero, from somewhere around 1 to 2% of holdings of these companies. And while the original justification for this move was to reduce oil exposure, and this on its face, this kind of makes sense because Norway as a country and given their ownership of majority ownership of Equinor, their state the NOC, the exposure of the fund is relatively high to oil, so it does make sense. However, we think that this dovetails very, very well with with their stated intent to become a more sustainable fund and promote greener aspects of business. And of course, E&Ps are really at the forefront of this ESG struggle. They don't have the capital, the flexibility, the global reach that many oil majors or larger players do to reduce their emissions, to reduce their carbon intensity, to divest, or to even diversify into less carbon intense businesses. And so we really think that this may sort of carry through as into other investment managers and really contributes to an increasingly challenged investment case longer term for these E&Ps for the reasons I just described.
Very interesting, Will. Elchin, I want to bring you back on to provide some perspective, looking more at the green energy space and the utility part of the picture. You put out a very interesting report that just 2 days ago, looking at, hey, look, there's a pullback in the the green stocks we've seen this year so far, and you go on and look at, well, what's the potential for M&A activity, IPOs in this space. And I'm particularly, I want you to talk about your report, but I also am curious if you think we're teeing up for a battle between the integrated oil majors or integrated energy companies and the utility-like names that you look after as they go after these green initiatives. Are they going to be looking? Are they going to want to buy the same companies?
Potentially, yes. However, there's a lot of smaller renewable players. Generally, they're specializing in early stage projects, so they take care of permitting and whatnot, and then a big player like a utility or an oil major buys them. I do see some competition there. However, we've also seen a bunch of deals coming through in the past month or so where utilities are actually teaming up with the oil companies, be that in offshore wind tenders, particularly in floating wind, which is a high risk technology. So oil majors and utilities want to spread the risk and maybe utilize their individual competencies. So there are a ton of collaboration opportunities. Again, as I said, floating offshore wind, but also carbon capture and storage, hydrogen production, and a bunch of others. So and even vanilla renewables when it comes to utilities trying to partner with oil majors to enter new markets. So there is a lot of competition. There's a lot of collaboration as well. And overall, yeah, that's not the biggest driver for the sell-off that I've described in my notes. Which I think may be over.
Yeah, very interesting, Elchin. I think we'll have to keep an eye on it. Both Will's note on Norway and Elchin's note on M&A activity, IPOs, and the utility green space are both available on BI Go on the terminal. And with that in mind, we're about to enter 2Q earnings season, and as part of our franchise here, we give a preview of the results that give our expectation for what we think is likely to occur. And so, if we could, I think it would be good to just do a quick run through Salih, Will, and Elchin on just kind of what are you watching for in 2Q results, and how do you think the quarter is going to shape up for the companies that you look after? So, Salih, we'll start with you. I know you've got a bit of a mixed bag. I know you look after Aramco on one hand and some of the independent refiners here in Europe on the other hand. But give us a sense, what's 2Q going to look like for your space?
Sure, thanks, Rob. And as you mentioned, I do look at a few different subsectors, but I think it's going to be a solid 2Q for all of them, because as we look through the value chain, I mean, these companies are in a much better position right now than they were at this point last year. And when we look at oil producers, the integrateds, I mean, they do have a much more favorable crude pricing environment, much better realized pricing. And when you look at downstream for these integrated companies or some of the pure refiners in Europe, they are looking at a slowly but gradually recovering refining margin. It's still not quite at the early 2020 levels, but it's getting there. So and then chemicals is another one. I mean, this is not a unit that every integrated company within my space has, but looking at companies like OMV, MOL, I mean, they are already in their preliminary trading updates. They are telling us about the continued strength in the chemicals business. So overall, it is going to be quite a strong quarter for them, and I think consensus expectations are reflecting this already.
Thank you, Salih. Okay, down the line, Will, let's hear from you. What are you expecting for the European oil majors in 2Q? Similar story?
Yeah, it's a similar story. The only thing I would really add here is that given the strength of the financial performance, which will not only be the strongest since the pandemic, but will probably be the strongest for most in the last 3 years, largely driven by the highest commodity pricing we've seen in a couple of years, very strong gas and LNG pricing. And so I think what this really will beg the question for many of these is what's the plan for shareholder distributions? And we've already started to see a couple of indications from Shell and BP on their early achievement of their net debt targets. And with this early achievement, there's going to be increasing questions about the scale of distributions moving forward. We expect these to largely be biased to buybacks as opposed to dividends, but we don't discount the possibility for marginal dividend recovery. And along with that, I think that given this widening free cash generation that we're going to see here, given continued capex discipline this year, then I think this creates not only the option for shareholder distributions, but also M&A capacity. So I think we can continue to see a focus on energy transition led M&A occurring for these companies as they as they're accelerating towards a much more diverse energy supply mix within the next decade.
Very interesting, Will. Okay, last but not least, Elchin, give us a sense of what's in store for the utility space as we head into 2Q earnings season.
For utilities, typically there's a ton of one-offs for pretty much every single company, but the fundamentals are improving. We are seeing higher power prices starting to trickle through to the earnings. However, again, utilities generally hedge their exposure, so we may see some short-term dip, but we see positive outlook for 2022. So the power demand and gas demand is improving. However, on the flip side, we are seeing the higher cost of sales. So a lot of utilities sell more energy than they produce, and with the commodity prices going up, it temporarily reduces their margins until they pass on the cost to the consumers. So in the short term, we are seeing actually some earnings are dipping, because of this timing effects. However, the 2022-2023 outlook is very strong because of the improving the demand and prices, and the biggest driver for improving earnings is also the increasing renewable capacity. So utilities are shutting their less profitable coal and gas-fired power plants and replacing that with wind and solar, which are much more profitable on per megawatt basis. So that's the key underlying drivers for the sector.
Fantastic, Elchin. I think we'll close it for today with those remarks. For everyone who's listening, we hold these calls on the first and third Wednesday of every month. you're welcome to join us. If you need the dial-in info, if you have any questions for us individually, shoot us an IB, shoot us an email. We're happy to get back to you. And everything we talked about is available on the terminal on BI Go. If you ever have any questions about any of the research or any of the data that we help to curate, please reach out. We're happy to speak to you. And I hope you have a great rest of your week. Thanks for your time today.